Hey guys, what's up? Alec back with the daily stock market, and look at that. A few stocks up 10%, Rivian up 10%, Redbox up 12%, Lucid up 6%, and then we have a bunch of other stocks that are down around 5% to 2%. Coinbase leading the pack, down almost 5%. Roblox down 4% after they had a rally the past few weeks, up 61% from lows of $25 per share on Roblox. We also have gold to a 52-week low, and it looks like it's going to be going towards a multi-year low if it breaks below that $15 support. So that's where we're looking for gold. Now in this video, we're going to be going over the best dividend stocks to be holding for long term, and naturally a lot of these stocks will also be safe defensive stocks that really don't move a lot. So if you're looking for long-term defensive stocks that will grow in share price and also pay a little bit of sweet dividend while we're at it, you came to the right place. And right before we dive into the video, take 1 second out, make sure you're subscribed with post notifications on YouTube, and go be a part of it on Twitter as well. I post awesome retweets there every single day. Now, when we're talking about dividend stocks, one of my favorites is Verizon, ticker symbol VZ, okay? In the last 3 months, it's only down 2%. So if you compare that against the rest of the market, Verizon's doing exceptionally well. They don't move too much. Also, you can see a 52-week low is only around 10% downward movements. So again, if you compare that past year to the rest of the market, Verizon is outpacing the market. However, in the last 5 years, it also doesn't move much. So you can think of this more as a cash park. And once it gets to 5-year lows around under $45 per share, I think I'm going to be moving a good amount of cash into Verizon. You can also see that they pay almost a 5% dividend yield, which is going to be one of the larger dividend yields, and that's why they made this list. Also, the PE ratio is 10, implying they are a pretty good deal right now with a market cap of $200 billion. AT&T is also a good pick for a dividend stock, but Verizon beats them in my opinion because of the defensiveness nature of the stock. As you can see, it doesn't really move much, so you're not risking like a 40% downward movement, 50% downward movement like you are with a lot of other stocks in the stock market. And what's a dividend video if we don't talk about Johnson & Johnson stock at $178 per share, ticker symbol JNJ. Okay, in the last 3 months, it's only down 0.2%, so far outpacing the market, and in the last year, it's actually up. It is one of the only stocks in the entire stock market that is up on the year. It's a defensive stock. It's also known as a recession-proof stock. They own many companies that are going to be used even in a recession, stuff like soaps, hand washes, diapers. I'll pop up a list of some of the companies they own right now. You can also see in the last 5 years, they're up 34%. So they're not like a huge growth stock, but they're a pretty consistent dividend yield with a 2.4% dividend yield, a PE ratio of 23, a market cap of $470 billion. So we do want to see them come down a little bit. I would probably be buying Johnson & Johnson if I can get it under $150 per share, which would be around a 52-week low. Then I'll be considered buying in Johnson & Johnson in a lump sum. However, I am dollar cost averaging for long term in Johnson & Johnson in my dividend stock portfolio. And most of these stocks that we talk about in this video are going to be great strategy to dollar cost average into them over the long term. And they're also mainly going to be for long-term investors. So if you don't have a 3-year or more mindset for dividend investing, it's probably a good idea to not even get involved with dividend investing because it really is going to be like a snowball effect. It starts very slow, the 5% yields, 4% yields, 6% yields, but over years and years, 5 years down the road, 10 years down the road, that's when the dividend stocks really pay off on your portfolio. Now, another great dividend stock is Home Depot, okay? Ticker symbol HD. This could be a good recession-proof stock. However, with the housing crash upon us, probably in the next 8 to 12 months, in my opinion, I would be careful buying the stock now because it will probably fall when house prices start to fall also. Less people will want to do upgrades to their homes, so on and so forth. And if we see a big housing crash, I think we can see this closer to $220 per share or even under $200 per share. Right now, we see Home Depot at a 52-week low, and we've actually seen them lose around 30% of their value. Dollar cost averaging could prove beneficial to Home Depot, especially under $300 per share. Okay, I think they will be over $300 per share again, but I'm really looking for a good deal if I'm going to be pouring thousands of dollars into Home Depot. Definitely want it under $250 per share, and for the most part, I would want it under $200 per share, which again, I think is definitely possible with a housing crash. Okay, we see a dividend yield of 2.5%, which is nice. You're also getting great growth from this company, from the Home Depot. That just the stock growth alone could outpace a lot of these other dividend stocks. Okay, with the from the dividend yields. The market cap is 290 billion, so it's a mega cap company. They've been a profitable company for a while, an extremely profitable company, and they've been beating earnings consistently. So the question is, can they keep it up over the long term? I think in the next 12 months, we'll have great buying opportunities for Home Depot. So that's why they are on my list at the price points we talked about. And we also have to talk about PG, Procter and Gamble. They're kind of similar to J&J in a strong way. However, in the last 3 months, they are down 4%, which is more than Johnson & Johnson. However, in the past year, they're up 8%. Okay, so I would want to see this one a lower, again, around $115 per share or under $130 per share for lump sum buying. Dollar cost averaging is going to prove the most effective method for Procter & Gamble. They provide a lot of recession-proof stuff like baby diapers, soaps, lotions, makeups. I'll actually pop up a screenshot so you can see what kind of companies they own as well, and if you want to be a part of that. Now, you can see here they have a PE ratio of 25, which is a little bit higher, okay, implying that Johnson & Johnson could be a better deal. They have a bigger market cap, and they have a dividend yield of 2.4%. So you can see in a lot of ways they are like Johnson & Johnson, but in a lot of ways they're also different. Is Procter & Gamble a risky investment? Legendary fund manager once said the biggest investment risk is not the volatility of the prices, but whether you will suffer a permanent loss of capital. It's only natural to consider a company's balance sheet when you examine how risky it is, since debt is often involved with a business's collapse, which is why we've been looking at balance sheets a lot recently. And if you want to learn how to look at balance sheets and income statements, message me on Instagram if you want to become a little bit more professional in the stock market and get to a more expert level. We've noted that Procter & Gamble does have a debt on its balance sheet, but the more important question is how much risk is that debt creating? So overall, analysts agree that there's around a 14% upside on Procter & Gamble over the next 12 months with that 2.5% dividend also attached, which would be looking closer to around a 16.5% upside over the next 12 months. Some analysts have them as high as $185. So we're not looking at huge 100%, 200% gains with Procter & Gamble or Johnson & Johnson, but it's more consistent growth. It's more defensive. You're not going to lose 40% of your stock's value over, the 52-week or less, like we've seen a lot of stocks happen in the stock market. They've survived this dip, and then one of the only stocks that's actually green in the last 52 weeks is Procter & Gamble, Johnson & Johnson. So again, you're not going to get huge growth from these stocks, but maybe even looking into leap options with expiration dates 12 to 24 months out could prove beneficial for something like Procter & Gamble or Johnson & Johnson, SPY, stuff like that as well. Visa is a stock we've been talking about recently, and I think they're going to have a nice comeback story. Also one that we're going to consider doing a put option on once they go closer to $215 per share, because you can see that up and down consistently is very consistent with Visa in the last 6 months or so. It has some pretty predictable price action, so if you want to get in the close friends list and see what I'm buying, when I'm buying, how much I'm buying, the expiration dates, the strike prices of different options, if I'm buying puts, calls, everything under the sun, message me on Instagram to get on my close friends list. Now I want to see Visa closer to around $175 or under, which would be a multiple year low. Around, they haven't really been that price in 2017 if you take the pandemic crash out of the scenario. So we'd be getting a great deal on Visa. You can see I'm down around $8 on my small position in Visa. You can see they have a 0.7 dividend stock. So they're really not much of a dividend stock. They're more of a growth stock. Actually, they're a profitable company, have a great EPS, and I think Visa can outpace the S&P 500 for the next 3 years, especially if I'm able to get in under $175 per share. Then I definitely think that Visa will be able to outpace the S&P 500. So if you have a little bit of a growth portfolio, this stock here, Visa, doesn't really match with the rest of the stocks in this video. But hey, it's just you can think of it as a bonus stock. Now I want to throw one more bonus stock in there that doesn't really fit with the rest of this video, but it's still a pretty good dividend stock, and that's Nintendo, ticker symbol NTDOY, and it's an ADR, so remember, be cautious of that, which means that it is a lot more risky. So that's why it doesn't really fit in with the video, because it is a lot more riskier than some of the other picks. Okay, it's in the last 5 years up only 32%, down 28% in the last 1 year, in the last 52 weeks, and it's recently just been as high as $67 in March. And if we scroll down, we can see they provide a 3.3 dividend yield, and they have a P ratio of 12. Okay, so if you want a little bit more risk in your portfolio, this one could be a good idea, especially if it gets into that $30 range, $35 range, which I definitely think is possible for Nintendo. But personally, I have price alerts set at around $43, so I might even consider nibbling in Nintendo under $43. But I really want to start buying Nintendo seriously if it does go under $35 and into 52-week lows. Because if you guys didn't know, Nintendo owns a lot of legendary brands. They own Pokemon, which is the biggest one. I think Pokemon is going to be a huge thing for at least the next 10 to 20 years. So that's why I'm pretty confident with that investment. They also own things like Mario, Super Mario, the Nintendo consoles. What's going on under the hood for Nintendo? We can see that their total revenue is absolutely killing it with 1.7 trillion in total revenue. And if we look at their net income and their total revenue, it looks like there is an error on Webull. So if someone wants to look into Nintendo, ticker symbol NTDOY's income statement and total revenue and check on these, because I'm pretty sure these are 100% not right. There's no way they're doing 1.7 trillion in total revenue. It's probably supposed to be billion. If I had to guess, 1.7 billion in total revenue, and probably closer to 470 million in net income. But message me on Instagram if you guys look into the income statement and you find what the correct numbers are for Nintendo. If we look at the balance sheet, it also looks like it has an amazing balance sheet. So on your own time, I would definitely look into this balance sheet to make sure this is correct. However, again, it looks like this balance sheet is inaccurate. So if someone could reach out to me on Instagram and post and send me the right balance sheet and the right income statement, and in one of the next videos, I'll do like a little update for everyone that watched this far on Nintendo's income statement and Nintendo's balance sheet. So I hope you guys really appreciate this video. Go ahead and smash a thumbs up and subscribe with post notifications if you haven't already. Share this video with a friend, and also make sure you go follow me over on Twitter if you are a Twitter user. I post helpful information every single day. I retweet a bunch of other people's tweets so you can get information from all over the place in one little sector. So think of my Twitter feed as your daily read. That's going to have a lot more information than I post on Instagram. So if you want even more information that I post on Instagram, make sure you follow me over on Twitter at TDSM Stocks. TDSM Stocks, TDSMs for the daily stock market. All right, guys, I'll see you guys in the next video. Remember, don't time the market, buy the market. Peace.